Before we begin this podcast, we would like to remind listeners that NetWealth is licensed to provide general financial product advice only, and that this podcast isn't tailored to any particular person's objectives, financial situation, or needs. Before a listener acts on any advice in this podcast, they need to think about whether it's appropriate for their circumstances or their clients, and consider the product disclosure statement for any proposed investment, and also seek any professional advice they need. NetWealth Investments Limited is the issuer of NetWealth's financial products. For NetWealth's financial services guide, contact details, and other information about our products and services, you can visit our website at netwealth.com.au. Today's guest is a financial product issuer. NetWealth and the guest have a commercial arrangement that enables investment in products managed by the guest through NetWealth's platform. Under that arrangement, NetWealth may receive fees from the guest. More information about the fees NetWealth receives is provided in our financial services guide.
Welcome to the NetWealth Portfolio Construction Podcast, brought to you by the NetWealth Investment Research Team. In this podcast series, we pick the brains of key wealth management professionals to uncover opportunities and challenges for investors on a diverse range of topics. We hope you enjoy their unique perspectives. In this episode, we explore the world of ETFs with Damon Gosen from VanEck and discuss what the next evolution of this asset class might look like.
My name is Paul O'Connor and I'm the Head of Investment Management and Research for NetWealth Investments Limited. In our role and ongoing day-to-day interaction, we deal a lot with the various product manufacturers that we have and we offer through our investment platform. And today we have Damon Gosen from VanEck. So before we get stuck into it, Damon, can you tell us a little bit about yourself and VanEck?
Thanks, Paul. So my name's Damon Gosen. I'm Vice President of Intermediaries at VanEck, which means that I look after business development with financial advisors, stockbrokers, different institutional clients as well, and represent our ASX-listed ETF range in the Australian market. But before VanEck, I've been in financial services for 15 years, spent around a decade with AXA and AMP Capital in various investment roles, and now been with VanEck for about 3 years. Question on who's VanEck. VanEck's a privately owned US funds management group. So it was founded in 1955. It's headquartered in New York. It's got offices around the world, including in Sydney and Melbourne. We're a very large active funds management business, but the biggest part of our business now is ETFs. We've been managing ETFs on the New York Stock Exchange since 2006. We have over 80 exchange-traded funds worldwide, including 15 on the ASX. Everything VanEck does is physically backed, so we won't do any synthetic ETFs, we won't do any structuring, they're clean strategies. We have 15 ETFs on the ASX, and I would say how I would describe what we do is one of two things. We will do the beyond the usual approaches to indexing. So,
what are those usual approaches to indexing?
Traditional indexes are market cap weighted indexes, so things like the S&P ASX 200 or the S&P 500. So the Australian market, the S&P ASX 200 owns the top 200 companies and it weights them by their market cap, so by their size. So effectively, that means you get 8.5% in Commonwealth Bank, and the best part of a decade ago, you would have had 13.5% in BHP when it was the biggest stock on the exchange.
And what do you mean by active management? You mentioned before, because I guess what I'm thinking is that the traditional exchange-traded fund available in the Australian market is considered a passive investment strategy.
Yep.
What do you mean by active?
So when we talk about active management, we talk about the objective is to try and outperform a particular market benchmark. And so in the Australian market, we don't have dedicated pure active strategies. We do have active funds in the US. And so globally and philosophically, we think active management makes sense in certain areas. So areas like emerging market equities or emerging market bonds, commodities, they're hard assets. Asset allocation, we believe in being active there. Where it crosses over into the ETF world is smart beta ETFs. So they're index strategies that are different from market cap weighted. So it might be tapping into a particular factor that's been shown to add value over time. So for instance, a quality factor, quality companies tend to do very well over time, tend to outperform over time. And we would make an argument to say, don't pay necessarily an active manager to tap into quality businesses. Do it in a rules-based ETF, such as our Qual ETF, QUAL, which is a fraction of the cost of an active fund, and that index methodology has outperformed by a significant margin over time.
Okay, so is it fair to say that a passive exchange traded fund or an ETF is really going to give the investor the investment return of the index, or aims to provide, and whereas you have a number of strategies that will aim to provide an index return, but also other strategies that will aim to outperform, and they are the active strategies.
Yeah, that's right. That's right. The smart beta or the factor-based indexes are offering a return different from the standard market benchmark and trying to enhance that return or offer a different risk-adjusted return. But yeah, so the standard passive just means traditional index, which is your market cap strategy, and so we'll offer alternatives to that. Yep.
Okay. Well, we know you have a keen interest in markets and asset classes. Do you mind sharing how this passion grew?
I studied economics. I grew up in a household where my dad was a financial advisor. So I've been following markets for a long time. I spend more time on the business development time now. That's my role exclusively, but was in investment roles actually building portfolios, and I still take a keen interest in that. I just find it very interesting how you should build portfolios, what you should get exposure to, what you should avoid exposure to. I really enjoy looking at different financial products as well and how they're structured, and hopefully avoiding ones that aren't particularly structured as well.
I guess part of it involves trying to look into a crystal ball and predict the future in terms of trying to work out how to build a diversified portfolio across asset classes. Given your role with VanEck, how are investors using exchange-traded funds or ETFs in their portfolios?
Yeah, a few different ways. We've got a few different client types. So firstly, there's just individual investors that will be using an ETF to express a particular view. So it might be that they want to get exposure to international shares or infrastructure or resources, and so they will use an ETF to get that position in their portfolio. We've got financial advisors, stockbroker clients that will use ETFs in their portfolio construction for clients. So sometimes they will use our ETFs as a replacement for an active fund manager. Sometimes they'll just use our replacement use us as a replacement for a standard index fund. The third client type is institutional clients. Typically, they're using ETFs to express asset allocation views. So we have, as clients of ours, some of Australia's biggest institutional investors using funds of ours. So, for example, our gold miners ETF, which trades both on the New York Stock Exchange and the ASX under the code GDX. We've had plenty of big institutional clients that use that ETF to hedge against financial system instability and use various ETFs of ours to make different macro calls on markets.
That's interesting. So I guess what you're saying is some people are using ETFs as a core building block in building and using their building diversified portfolios, i.e. to give you an exposure to Australian equities, whereas other investors are using it for more of a niche asset allocation, to your example about the gold ETF there.
Mm-hmm. Yes.
Okay, well, what sort of opportunities are you seeing out there in the market and that specifically are underrepresented in investor portfolios?
A few examples. This is an area where we always think what we think about when we bring new products to market, things that we think investors should own but typically don't. So a few examples. One is in Aussie equities, mid-cap stocks. Time and time again, we'll see portfolios that are 80% to large cap stocks and 20% to some small cap fund. And what is underrepresented there is the mid-cap sector, which year in, year out for a very long period of time has offered the highest risk-adjusted returns, but are typically only a fraction of the investment amount. To us, that doesn't make sense. So we bring a dedicated mid-cap strategy to market. On the defensive side, a traditional bond strategy gives exposure these days to a predominantly government debt, which is super low yielding, a lot of interest rate risk, i.e. as interest rates rise, there's going to be price falls in that. Our view is that floating rate bonds are a great area to own, which uses actual interest rate rises as a tailwind. Floating rate bonds are very vanilla, don't have price volatility, but yet most investors don't own them. So we've just got a very clean strategy, FLOT, their infrastructure. That's an asset class that institutional investors are moving more and more into and allocating bigger portions of their wealth into, but the standard retail investor would not have much exposure to infrastructure and a massive tailwind behind that as effectively the developed world, and US in particular, spends an enormous amount of money building out infrastructure projects, and infrastructure stocks are beneficiaries of that, or will be beneficiaries of that. So just three areas there.
Yeah, well, I think that's a couple of good areas. I think we can all understand in the current low interest rate environment what a low return we're getting on our bank accounts or our term deposits. But we're also seeing that ongoing need to build infrastructure, whether that's airports, roads, bridges, across both the developed world like the US or the emerging world like China and various countries in Asia. I guess I'm starting to see some very specific ETFs being created, such as cybersecurity, aerospace and defence ETFs, etc. And you touched on it earlier when you gave the example about the gold ETF. What are the more interesting ETFs you're seeing, and what sort of product development are you guys thinking about now, looking forward?
So in terms of, I guess I'd probably say interesting is not always, doesn't necessarily always mean good. So that's the ex-investment researcher in me going, just because something seems interesting, actually probably it could be a red flag in a way. And sometimes the very niche types of strategies are exactly that. It's a great marketing thematic. Needless to say, there's sometimes very good ideas there. Just one interesting thing in our view is we've just listed an ETF, a global sustainability ETF, and we have had for a long period of time, we've been working on this, we've had a ton of demand from institutional clients, from financial advisors, and from individual investors saying, we really take an active interest in what we hold in our portfolios. We don't want to be exposed to certain sectors, and we do want exposure to certain sectors. And so we've partnered with MSCI, the biggest global index provider, and also they are the leader in environmental, social and governance research, so ESG research, to do an index which actually identifies the lowest carbon impact companies and the leaders in terms of ESG, plus also removes the sectors that are probably more controversial sectors like alcohol and gambling and tobacco and the like. And so that's just, I guess, to me, that's a very interesting topic, because there's something in the realm of like $10 trillion that's been allocated to ESG or sustainable investments globally in the last decade, and an ETF is a perfect vehicle for that because it's so transparent and gives the investor exposure there.
Yeah, well, I guess that's in line with the observations that we're seeing at NetWealth in terms of building out a broad investment menu. We're getting a lot of interest in more ethical or environmental, social and governance investment strategies. So I think people are getting a little bit more conscious about what they're actually investing their portfolios into. All right, and I think finally, can you provide our listeners with an interesting investing rule or tip that you've learned, that you live by, that you implement in your own investment portfolio?
I would love to. I like history, so I think back to the GFC. And the types of products that served investors really poorly were either heavily structured, they were geared, they owned in liquid assets, or were derivative-based. So, and sometimes all of those things. And so in terms of a tip, boring is really, really good. Think long-term, make sure the investment strategy stacks up and the underlying assets are actually there within the fund, physically held.
Great. Well, thank you very much, Damon, for joining us on this Investment Leaders podcast series. And I hope that listeners gain some insights into the development of exchange-traded funds and Damon Gosen's own investment insights. Thank you very much, all.
Thanks, Paul.
Thanks for listening to this episode of the NetWealth Portfolio Construction podcast series. For more episodes and to subscribe to our series, visit our website www.netwealth.com.au or visit the iTunes Store or Spotify. We hope you can tune into our next episode.